So now we finally come to the heart of our program, the Margin Tax Initiative, which is question 3 on the November general election ballot. It's the most important issue currently facing our business community. If passed by voters, it would enact a complicated and costly tax that would impact businesses of all sizes and industries. The proposed tax, it's fair to say, is confusing, and there are quite a few questions being asked as to how it would work, how it would be implemented, and how it would be calculated. Today's luncheon is an opportunity to hear from some tax experts with the intent of us getting some answers. The Metro Chamber is pleased to present this opportunity to hear firsthand about this issue so that you can make an informed decision at the ballot box. Now, it's my pleasure to introduce our panelists. And maybe you could kind of come up as I do. Joe Henchman is the Vice President of Legal and State Projects for the Tax Foundation, a nonpartisan research think tank based in Washington, D.C. Joe is a leading tax policy expert and will share information as to what the margin tax would mean to Nevada's tax environment and how it would position Nevada in comparison to other states. Please welcome Joe Henchman. Kurt Anderson is CEO of Fair Anderson and Langerman CPAs and Business Advisors. Kurt is a Metro Chamber member and a CPA with numerous small and medium-sized business clients. He'll share with us case studies of how the tax would impact real businesses. Please give a hand to Kurt Anderson. Chris Nielsen, whom I just met, is Executive Director of Nevada Department of Taxation. If voters pass the margin tax, Chris and his team will have to implement it in less than 40 days. Chris will discuss just how his department would do that, including the development of regulations and compliance processes. Please help me welcome Chris Nielsen. And finally, our moderator for this panel is a woman whom many of you know and respect. Carol Villardo is the longtime president of the Nevada Taxpayers Association. NTA is a nonpartisan association focused on promoting sound fiscal policies that aid in the economic well-being of Nevadans. Carol is widely recognized as the top tax policy expert in Nevada. And if please, a hand for Carol Villardo, warm welcome for Carol Villardo. So now I'm going to turn the program over to Carol and our panelists, and after each gives a short overview, I think, is the plan. We'll take questions a little later on. Chamber staff will have microphones in the audience, and you can just raise your hand and we'll respond. And Carol, please take it away.
Thank you, everybody. It's a pleasure to be here this afternoon. Many of us on the panel have been speaking around the state, trying to inform businesses about the details of the margin tax. Most everybody knows about the margin tax, but what do you really know about the impacts to your business? And I think we've got an outstanding panel today. Joe Henchman, I know, is very familiar with gross receipts tax and the Texas margins tax, and will be able to provide an overview, as Mr. Anderson, as an accountant, is definitely going to be able to explain some of the impacts that he has found with his business. And Chris Nielsen will be on the firing line, and if he doesn't get it straight, if God forbid it passes, we're all going to be ready to shoot him. So with that, I am going to go right into the presentations and start with Joe, if you'd give us an overview. Thank you.
Well, good afternoon, and thank you all for inviting me. It's always a pleasure to come out to Nevada, at least escape Washington, D.C. It's 92 degrees and about 150% humidity in Washington today, so it's good to be here in a much drier heat, closer to I'm originally from San Diego, California, so this is more home to me than Washington is. I wanted to kind of go through some of the flaws that we see in gross receipts taxes in general and the margin tax in particular, but I thought it might be helpful to just start off with a basic overview. And for a lot of people, I'm sure this is going to be nothing you don't already know, So just to kind of a reiteration of what is in this proposal, but we're going to be building upon it as we go through the discussion. So what is the margin tax? It is a modified gross receipts tax, gross receipts tax being a category, we'll come back to that. And it's originally created in Texas where they had a rate of 1%. The Nevada proposal, of course, is 2%. The tax is imposed on all entities and individuals engaging in business regardless of profit. So it's based on your revenue, not on your profits. It's a 2% tax on business margin minus your modified business tax that you pay. Margin, in turn, is defined as the least of 3 different calculations. So if you're a business, you calculate your 3 different bases and you pay the least. So your 3 bases are A, 70% of total revenue, B, total revenue minus cost of goods sold, and I've got an asterisk there, we'll come back to that, and C, total revenue minus compensation. I've got another asterisk there, we'll come back to that. There's an exemption threshold, that's italicized, we'll come back to that, of $1 million in revenues. Affiliated groups, that is combinations of different companies, they'll be treated as the same if there is unity of ownership, yet another asterisk, we'll come back to that. Functional integration, centralized management, and economies of scale. If there are a number of businesses that meet that requirement, they will be treated as one entity and have to use the same base. So if one of those entities uses 70% of total revenue, for instance, all of the entities in that affiliated group have to do that. And of course, it's question 3 on the November ballot, and the estimate is that it'll raise between $650 and $750 million in additional revenue. Now the asterisks, the first one was on cost of goods sold there. There is a federal term, cost of goods sold, which if you fill out a lot of federal taxes, federal business taxes you know and love, that is not the definition that's used in the Nevada one. It's significantly different. Things like advertising, interest, selling and distribution costs, litigation, depreciation, all of these which the federal government for tax purposes treats as business costs will not be treated as business costs under the Nevada proposal. Texas did a similar thing until very recently when they, after enduring years of litigation over the definition of state cost of goods sold versus federal cost of goods sold, just recently moved to the federal definition. You won't have that luxury. You're stuck with the Nevada definition if this were to pass for at least a couple of years. The next asterisk was on compensation. This is wages and benefits. Up to a certain level, wages are actually capped at $300,000. So if you have anyone in your company who makes over that amount of money, that won't count towards the compensation. Threshold is italicized there, exemption threshold of $1 million. I highlight this just to point out that this is not an exemption. This is what we in the biz call a cliff. So just as an example, if your business earns $999,999, you will pay 0 margin tax. If your business earns that $1 additional dollar, you are now liable for the tax on the entire amount, which would be $14,000. So on that $1 of revenue that you earn between $999,999 and $1 million, you will owe a $14,000 tax bill, which is a 1.4 million % tax rate. So it's pretty high. Generally, in designing taxes, you try to avoid cliffs like this, and if you're a high-income person who's filled out your income taxes, you're familiar with phase-outs and thresholds and those long forms and schedules in the tax booklet. If you're a sadist like me and you fill out your taxes by hand, those are attempting to do those things so that to make sure that you don't face situations like, well, if I earn $1 more, I'm going to owe $14,000, so let me do what I can to avoid that. And then finally, there's an asterisk down by unity of ownership. The reason there's an asterisk there is it's undefined in the initiative. Texas has a definition of more than 50% controlling interest counts as unity of ownership. I guess here we'll be at the mercy of Mr. Nielsen to give a ruling on what that is because it's not defined in the initiative. It really should be. You're going to hear a lot on Texas today. Why Texas? Well, gross receipts taxes, as I mentioned, are a category of taxes. They're mostly dying. They remain in Delaware and Washington State, those are the primary ones that still exist. They've had them for a long time. Virginia has local gross receipts taxes in existence. Ohio recently adopted one about 10 years ago, and of course then there's the Texas margin tax. Michigan has had a modified one since the 1970s, and after decades of trying to make it work, repealed it a couple of years ago. So the Michigan one is gone. Kentucky in 2006 adopted one and then repealed it before it even took effect, after it became clear how much of a mess it was going to be if it did actually take effect. So the world of gross receipts taxes is very small, and lest you think the organizers of this panel went out and found the one expert out there who hates gross receipts taxes, let me assure you that they did not. This is something that's general in the literature and general among experts. These are bad taxes for all of the reasons that I'm going to go into, and that's the view across the political spectrum among public finance experts. So what happened in Texas? Why did Texas adopt it? Well, their state Supreme Court ordered additional education spending. That shouldn't be a surprise. A similar thing had happened in Nevada a couple of years ago. And additional cross-district equity. So you had a heavy dependence on local property taxes, and high income or high property value districts had really good schools, and low property value districts had really bad schools. And the state Supreme Court said, you need to fix this. This isn't right. Texas, of course, has no state income tax, and their local property taxes hit the cap, so there wasn't a lot of room for what they could do aside from going after business taxes. So they took their 4.5% corporate income tax, which they called a franchise tax, and they decided what they need to do is spread it beyond C corporations. So just start hitting S corporations and partnerships and LLCs, and so that was one goal, is to expand the scope of the business tax. Another goal was to increase money for education to meet the court's mandate. Another was to reduce property taxes, again, to meet the court's mandate. And so they adopted it. It was signed into law in 2006, and collections started January 1 of 2008. Overall, the rate was 1%, except for wholesalers and retailers, which paid a 0.5% rate. Again, that's not in the Nevada proposal. Nevada, everybody will pay 2%. And you'll see in a bit why that in particular is especially problematic. It's important to note that they were way off on the revenue estimates. They expected it would collect $6.4 billion in 2010. In actuality, it collected $3.9 billion. And the comptroller thinks that about $1 billion of that was due to the recession. Of course, this was implemented right as the economy went into free fall. But about $1.5 billion was just because the tax was poorly designed, and they guessed wrong on how people would pick bases and how it would perform. And as I've mentioned, Texas has made significant changes in recent years to the margin tax. Every year, they face a flurry of bills to repeal or significantly modify the tax. I don't know whether anybody out there is saying, well, Texas is successful and they have a margin tax, so therefore we ought to have one, it won't cause any harm. Texas is successful in spite of the margin tax, and they know it. You can talk to anyone who does business in Texas, the problems that this is causing. So they've done a number of recent changes to try to reduce the negative effects of their margin tax. They've reduced the rate now. If it's from 1% now, and it's down to 0.95%. They've adopted the federal cost of goods sold definition rather than having their own, and they've made the small business threshold permanent. It was originally planned to expire. And they've got a gubernatorial election coming up, and out of all things, this margin tax looks like it's going to be a key statewide issue, with some of the candidates talking about repealing it because of the drag it's causing on economic growth. So to calculate it, I just wanted to give you a quick example. This was from a law review article that someone put together. So take a service corporation. They have $950,000 in revenue and $1.05 million in expenses. Wasn't a good year for them. They had a $100,000 loss. So their expenses are broken down as $350,000 in compensation to employees, $650,000 in compensation to independent contractors, and $50,000 in other expenses, cost of goods sold stuff. If they were paying a corporate income tax, they would pay zero because they had no profits. Zero, whatever the rate is, it's based on zero, so nothing. But under the margin tax, what you do is you take the three bases and you calculate what your margin is. So there's the 70% of total revenue base, that would be $665,000, that's 70% times $950,000. There's revenue minus cost of goods sold, and that would equate to a $950,000 base because they don't get to subtract anything given the type of company that they are under the definition of cost of goods sold. Everything that they do doesn't count under the state definitions in the initiative. And then the third base is revenue minus compensation, and again, the only thing that counts for that is compensation to employees, not compensation to independent contractors. So you have these three bases. You take the least, which is $600,000, and in Texas you pay 1%, so that's $6,000. So an unprofitable business pays $6,000 on their taxes. But that just gives you an idea of how you would go about calculating it. And for the business owners in the audience, you know, sit down, take last year's numbers for you, and figure out what would you owe under this 2% proposal. So what is wrong with the margin tax? We have 5 things that we kind of identify as problematic with the margin tax in Texas in particular, as well as in the proposal for Nevada. I think any 5 of these are good enough reasons to not adopt this type of tax structure for your state, but we're going to go through all 5 just to be thorough. So 1 is pyramiding is inherent to the structure. 2 is that it taxes industries differently. 3 is that it lacks horizontal equity. 4, that the complexity causes high compliance and administrative costs. And 5, that it causes distortions in business behavior. So let's go through these. 1 is that the pyramiding is inherent to structure. How gross receipts taxes work is they hit every level of production. And the classic example that is described in all of the public finance textbooks is the production of bread. So a farmer buys seed and fertilizer, and he pays the gross receipts tax on seed and fertilizer. And then he sells the wheat that he grows to the miller, and again, taxes paid on that sale. And then the miller turns it into flour, and he sells it to the baker, and taxes paid once again. And then when the baker sells it to the customer, then taxes collected again. Now, if you've been following along, there's taxes being imposed on taxes because the total amount of the transaction is then built into the subsequent sale, which is built into the subsequent sale, and so on. So what you have is what economists call pyramiding. This tax base is bigger than the economy as a whole. And in Washington State, they estimated this pyramid's about 2.5 times in their economy. An example done in Nevada finds that although this is just a 2% rate, it's equivalent to a 15% corporate income tax because that's how many times it pyramids through the economy. It's important to note this is inherent in the tax. If you were to try to make changes to reduce pyramiding, what you would turn it would no longer be a gross receipts tax. You would turn it into a sales tax or a corporate income tax or a license tax or one of the other more recognizable taxes out there. But the pyramiding is inherent into the structure of gross receipts taxes. The second point is that it taxes industries differently. And Texas found this, found that for the most part, the share of liability by industry matches the Texas economy, but I wouldn't expect that to be the same for Nevada because you do not have that lower wholesaler retailer rate that Texas does. You do not, in the initiative, it does not exempt insurance and health care the way it does in Texas, and gambling revenues are exempt under the Texas proposal. But just to give you an example from Texas, the comptroller put this together. This is effective tax rate by industry. So this is the percentage that you see is the tax paid as a percent of total revenues. And there's significant variation. So agriculture 0.12%, truck transportation 0.38%, telecom 0.858%, health services 0.37%. So just depending on how many levels of production you have in your industry and how you're structured, it creates a significant amount of variation. And that's the third point is that it lacks horizontal equity. You can have otherwise identical businesses that differ only in their structure, and they'll pay very different taxes. So if you have salaries versus independent contractors, that's significantly different treatment. If you have affiliated companies, that's significantly different treatment. The fourth point is on complexity causing high administrative and compliance costs. This will be a new tax, and everybody's going to start from scratch on it. And all of the corpus of regulatory rulings and guidelines and everything, I mean, you're starting from scratch on all of that stuff. And there's not much time, as was mentioned. If this was passed in November, you go to start collecting, start complying as of January 1, 2015, so not a lot of time to get together. It'll mean 2 sets of books on cost of goods sold, You have to file even if you don't know, because you have to know whether you hit the threshold or not. And it's going to depend heavily on regulatory rulings. And it's important to note that Texas has had about 40 ongoing lawsuits since the margin tax was adopted. Last slide. The fifth point is that it causes distortions in business behavior. So I've put this into kind of three categories of businesses, and so if you're from a business in the audience, try to identify where you are on here, and you'll know how you're going to be treated under this. So first, there's the category that will be harmed badly. This is businesses with very little that fits under the state definition of cost of goods sold, service businesses or consumers, people who buy from service businesses, unprofitable businesses, because you'll pay a tax that you don't pay otherwise, and I think it's going to harm Nevada economic growth and job creation. Also harmed, but not as badly, are businesses that avoid that cliff under $1 million. If you use independent contractors, if you're a goods business, if you're vertically integrated and you don't have a lot of production chains from raw material to final sale, and if you're a multi-state business, because then you can absorb the compliance costs better than if you're just a smaller in-state business. And like anything else, there's winners. The winners are going to be tax accountants and attorneys. You're going to have a lot of business. And states that compete with Nevada for jobs and entrepreneurs, because Nevada is going to look a whole lot worse. And with that, I'll turn it back over to Carol.
Thank you very much, Joe. And we're going to move right along into the presentation by Kurt Anderson.
I've been doing public speaking since I was 13 years old, and I've learned that the best thing for me to be doing is standing and moving to create less of a target. So I can't sit and do a presentation. I think, as Joe was saying, one of the most difficult things here is that this tax is being marketed just like the Texas franchise tax. And that statement is just disingenuous at best. It's just not true. As Joe said, the rate is 2 to 4 times the Texas rate. It taxes individuals, which Texas doesn't do. It doesn't have clarifications as to how to apply the law to construction contractors, real estate brokers, and certain control groups. Now these areas, there's more clarifications than just this, but these are the ones that you can just see really hit our economy very, very, very hard. Construction contractors, that's a lifeblood industry. Real estate brokers, lifeblood industry. And those clarifications were in the Texas law, and for some reason they're not in the Nevada law. No $1 million exemption. It's a threshold, as Joe said. You can lose real money and owe the tax. And I've got examples of these various concepts. You cannot change this mess for 3 years. 3 years, we're stuck with this. They started amending this law in Texas starting in 2008. We have clients in Texas. So we've been dealing with the Texas margin tax since it was initiated, and we've seen the changes over the last 5-6 years. So we know that they had trouble putting this together, and they got a lot of industry input putting it together to begin with, and they still had to modify it in that process, and they still have a lot of litigation over this. The cost of compliance. Now, you know that when an accountant says, I really don't want to be charging these egregious fees to do something, there has to be a problem. But our state society came out and said, we are not in favor of the margin tax because of exactly that issue. It's going to be a wild fee-generating process for lawyers and accountants, and we really don't want to be charging that money for what is of little or no value to our clients. That's the truth. That's the dead honest truth. So what does that tell you? I've never walked away from a good fee in my life that I know of, except for some clients in here. I've walked away from your fees. So we don't even know who. I still cannot find out who wrote this thing. You know, you hear these various apocryphal stories. You know, it was a second-year law student at the Guam School of Law and Plumbing. It's a band of gypsies that are ticked off over the live entertainment tax. I mean, you hear these stories. I still to this day don't know who really wrote this law. And what they should have done, if they really wanted to do this, is get the Xerox machine out, take the Texas law, and run it through. Just run it through. because that's what they're purporting this is. It's just the Texas law. Well, if that's the case, Xerox the thing and be done with it. But they didn't. Somebody decided that, well, this isn't important, that isn't important. And this Texas law is 60-some-odd pages long. The Nevada law is 26 pages long. Somebody, in their infinite wisdom, decided to start cutting things out, which left us with this muddled mess. It's terrible. So the only word that I can think of in polite company for this is it's an abomination. It is just an absolute abomination. Even if you believe in the concept of the tax, even if you think that that's okay, this document is the worst document you would use to actually do it. So on its own, it's a terrible legal document. It borders on malpractice, if you ask me. So to propose this as a concept is bad enough. To propose implementing the concept with this trash, to be honest with you, is very, very disconcerting. Very, very disconcerting. This is an indictment of our process here in the state of Nevada, that this is what we're dealing with. That's how bad this thing is. Not that I have an opinion, mind you. I tell this story. I got asked to do a presentation on this by Monty Miller for the Keystone Group. So I said, oh, okay, fine, I'll do that. And I, like a lot, had not really paid enough attention to this, admittedly. So I'm on the plane up to San Jose with my wife to see our kids and grandchild. And I'm reading this thing on the plane. And being of the Scotch-Irish temperament that I am, there's some going on. And my wife looks at me and she goes, what's your problem? And I said, I'm reading this law. And it is unbelievable how bad it is. Because I'm thinking there, all I'm doing is thinking about me. You know, that's where you go with this. And I'm looking at this as it relates to my accounting firm, my real estate company. I'm involved in a number of different businesses, and I'm thinking, this thing's going to cost me a lot of jack. This is terribly written. And I know how it works because I've seen it in Texas, and I can see the missing pieces of the Texas law as it relates to how to implement this, and I can see what's going to start happening. So as an example, what I did is I went back to clients, and anonymously, obviously, and looked at some different instances of real-world examples of what this tax would do had it applied in their 2012, 2013 returns. And I picked a few selected examples here to make the points that Joe made. You can lose your posterior and owe this tax. This is real. A restaurant losing money. Now there's a concept nobody's ever heard of, right? Lost money, close to $500,000. This is real cash. This restaurant is no longer open, by the way, as you would kind of wonder. So you work through all the various calculations. The bottom line is that they owe $16,500 in tax. Now they get a little offset for the modified business tax, but it's $13,000 on top of a $445,000 deficit. This works well. Tom Skanke ought to be rolling around on the floor on this one. This is a website hosting, I'm sorry? I'll get yours together and then you can worry about that. But this is a technology-related business, website hosting and servicing. What are we trying to do in the state? We want to modify our dependence on a single industry. We want to bring in new industry. We want to make technology our friend here, right? Well, this will work. Take a look at this thing. They make a modest profit. They're making money. Bottom line, when you go to their taxable income, they pay $69,000 gross, pay $48,000 after the MBT offset. When you relate that tax rate to their income, it's a 17% tax rate after the MBT. Now think about that. 40 or maybe 44% effective federal tax rate, 17% tax rate for the state. They're going to be coming in droves, don't you think? I don't get this. Here's the classic example of our cliff. Small company, design studio, they went $1,780 over the $1 million threshold, the cliff. $1,780. And they pay $6,850 because of that $1,780. That works real well. So what they should have done is shut down for the last 2 weeks in December, I guess. But this is the example. That cliff that Joe talked about is truly a cliff. And depending upon your circumstances, that might have been even more than $6,850. Here's a general retailer. Again, lifeblood of our economy here, retail. What's their effective rate? 5.5%, 5.3% after the MBT offset. John Guidry from Bank of Nevada made a good point, and you'll notice that I have on here the effective tax rate on a combined basis, because when people are looking at coming here, there really is the point that, yeah, we've got the modified business tax, and that's there as a cost of doing business here from a state standpoint. So if you look at that gross rate, it's 6.4%, because that's what somebody coming here is going to look at. Not only what am I paying on a net basis, but what am I paying on that modified business tax, because that's tax. Call it what you will, it's a tax. It's the cost of doing business if I move to Nevada. This gives you the range of, off of some of the examples that we've done with our clients, this gives you the range of how high this goes. Let me give you, I don't have the example in here, but let me give you a classic example of this clarification issue that just is nuts. I took a real estate broker, and by the way, I am one in another business I own. Because independent contractors are what you use in the real estate brokerage industry, you do not have compensation. So this poor guy runs this business, right? Bottom line is to $1.5 million. This sounds really wonderful, except that most of his money that comes in the door goes out the door to independent contractors, then he gets to cover his overhead and what have you. And he makes a nice bottom line. The deal is, though, that if he does not get a clarification benefit from Chris,
Yes,
listening?
I am.
If there's no clarification that what they intended was that he should be able to not include that revenue that went out to his independent contractors, you know what his Nevada margin tax rate is? 81.4%. On top of that, he's got the 40% federal rate, 125% tax rate. Now, how long do you think that's going to work? Not very long. Similar issue in construction. There's a question in construction as to whether general contractors qualify for the cost of goods deduction. Now, strangely, they dealt with that in Texas. And it was right there in that law that they could have Xeroxed, and they didn't put it in. And so now, Chris, there's another one to add to the list. I love this. I love this. Actually, I feel sorry for this poor guy. If this thing passes, he's in a tough spot. And I'm not going to make it easy, by the way, in that process, because these exceptions, these clarifications were crucial in the implementation of the Texas tax. And just because this second-year law student from that school in Guam, or wherever he was, didn't get him in there, we better look at how we interpret this law. We better be looking at this, or it's just going to fly. This control group thing will create a nightmare of cost. Because the way it's defined, you don't need 50% ownership to have control. You can have control just by virtue of owning a percentage of ownership and having the effective control of an enterprise at whatever percentage you own. And in the real estate industry, know that developers frequently have small percentages, maybe 10, 20% of a deal, and they got 80% of investors. And if that developer owns a bunch of interests in a bunch of different partnerships, that could be construed as control, could be construed as requiring an affiliated group, could be construed as all those have to file together and pay the tax because of that lack of definition of control for the purpose of the affiliated group filing. I'd like to find the guy who wrote this thing. I really would. I'm telling you, this is just, like I said, it's so bad I get worked up about, I think all of us believe that there are things necessary to this state to make it what it needs to continue to be. There's no question about that. And I think we need to figure out how to make these decisions properly and not engage in this kind of a process. This is dumb. It's dumb. And it's dangerous because now we're faced with this thing that could be here and it could mire us down for everybody who's here. It could keep people from coming here. And now all these kids that we're trying to make the world better by giving them a great education, we just messed them up because we lost all their jobs. Because they're gone. Who can afford to pay employees and grow when you're paying these effective tax rates and when companies won't come in to create new jobs? what are we doing to ourselves? You have to ask yourself this. Enough moralizing. I'm done. Anyway, thank you.
Thank you.
Good afternoon. Again, I'm Chris Nielsen. I'm head of the State Tax Department, and it's already been touched on by Kurt and Joe that there are going to be some administrative challenges, not just to get this tax implemented and implemented in a timely manner, but to sift through all the knowns and unknowns as far as what's taxable, what's in, what's out, what's deductible, what isn't. And as Kurt mentioned, the margins, the initiative petition as written is very short given the complexity of the tax. So what we're going to rely upon is we have administrative regulations here in Nevada. And it simply isn't the tax department issuing some sort of bulletin and sending it out to businesses or putting it on the website. We're required by law to go through the regulatory process, which requires, and I think for good reason, to hold public hearings, to hold adoption hearings, and then it will eventually become a codified regulation, which here in Nevada has the same force and effect as the statute. We will be limited in that there is kind of this gray area about what we can address and what we cannot address given the 3-year prohibition on changing the statutory language. So again, the devil's always in the details. The tax department will certainly, we envision being in the regulatory process, not just for 1 month or 2 months, but for probably years continuously. And it will have to be fine-tuned, and we're gonna have to rely upon input from everybody. And I think part of the challenge, certainly I'm gonna have administrative challenges, and not just in hiring competent staff to administer this, but it's going to take a while to ramp up those hires. It's going to take a while to go through the regulatory process. And this frustration and this timing is going to be turned into a frustration to the business community, because understandably when your accountants or your tax professionals call up the tax department and want an answer, is this in or is this out, or how do I treat this or treat that, when it's going to be difficult for me to give a precise answer, or even an answer sometimes, without going through this administrative process, without having the staff. So there's going to be a huge, I believe, frustration factor, not just from a government perspective, but again, that's going to translate to the business community. And I will be the businessman, I think, in the state, or one of the businessmen in the state, should this pass in November. I think I told my wife already that she and the kids can go on the family Christmas vacation to Hawaii, and Dad will be staying home because I'll be working on this. Just some facts. We're going to have to increase the Department of Taxation staffing when all is said and done. At least we anticipate this, about a 1/3 increase in staffing levels. This will be a complete new division within the tax department. The current employees that we have, primarily, although we have a number of tax types, the bread and butter are sales and use tax and the modified business tax, which are relatively simple to administer. There are relatively few gray area issues. There are relatively few challenges. I think this tax type should have passed will be the complete opposite. So there will not only be this time frame to implement the regulatory structure and to bring new staff on board, but a little bit further down the road, and I think lawsuits were mentioned earlier, I fully expect, if not some sort of constitutional challenge, whatever that may be, but more specifically challenges or appeals with regard to whether certain deductions are taxable or not. Because I'm going to have to be able, or my staff's going to have to be able to give the advice in a relatively short period of time, whether something's in or not. And one of the areas is this attribution rule with respect to related entities. It's not as simple as it maybe meets the eye, at least as far as what it is at the federal level. For example, you can have a business based here in Nevada that has a related entity in Arizona doing business, and the Nevada-based business does $900,000 worth of business, and the Arizona business does $150,000 $101,000 worth of business. Well, guess what? Then that business in Nevada is now subject to the margins tax. And I expect my staff to field a lot of these questions, although these aren't. This is a policy that that is going to the voters. Nevertheless, that I will get those questions about why is this fair, why is this isn't, and I'm not here to really weigh in on that. But that will bottleneck the real challenge, I think, that you all will have in your tax professionals is what is deductible and what isn't. Down the road in years 2 and 3, once this is implemented, once the audits begin, I suspect this apportionment issue will probably be one of the ones that will be litigated the most. In other words, what income is truly apportioned to to the activities outside of the state, and what income should be properly attributed to the activities of in-state. For guidance, the Texas margins tax largely mirrors the federal, at least as far as the definitions go. As alluded to, we quote, decouple rather quickly in this proposal from those federal definitions, and again, that decoupling, at least at the federal level, there are, for good or bad, it's a well-defined body of law that has numerous internal revenue regulations, private letter rulings. There's at least something that the tax professionals and my staff would be able to look for in giving an example. And we certainly wouldn't have this at this point. And so this could impact, it'll impact everything. It'll impact the initial filing of the tax returns, and it will impact the auditings in the out years. So I guess the general theme is, while there's a cost to the state, there's going to be, I believe, a huge cost to the business community. And this so-called cost of compliance isn't, I don't think it's going to be cheap. Typically, the typical business in Nevada, at least non-gaming business, most pay some sort of sales and use tax, a modified business tax, and some other licenses and fees that are simple to understand and are very not very costly to administer. I mean, our sales and use tax return is 1 page long. It's, what were your sales? You apply the rate. Our modified business tax, we essentially, it's just a tax based on what the net wages are, and there's only one deduction. It's the healthcare deduction. So it's a very simple, we currently have very simple taxes to administer, and we're going to go from that, or we'll continue to have that, but under this proposal, I believe Joe, correct me if I'm wrong, I think there's a short version and long version of what the actual return looks like in Texas. Mm-hmm. And I believe the short return is 7 or 8 pages long, and then the long version is significantly longer than that. Well, that's going to not just create more challenges for my staff, but it's certainly going to cost you as far as paying the tax professional, or if some of the businesses that are smaller, typically have bookkeepers even. I mean, because again, this taxes are relatively easy, well established, and to understand. Well, now that business is probably going to have to go out and hire an accountant or some sort of tax professional to just even file the return. So, with all that, I expect, and then from a timings perspective, the revenue generated will begin to be impacted January 1 should this pass. Now there'll be a time period for my agency to implement, do the IT retooling, do the hiring, do the regulations, but it's going to be difficult to ask or to answer some of these specific questions that I believe the business community is entitled to. We typically rely upon the Attorney General's office when we get legal questions. Well, last time I checked, they don't have any experts in Texas or in margins tax. So it's going to be a learning curve for everybody in government, I believe. Having said that, those are the primary challenges that I'm facing that will create challenges and frustration on your part as well, I believe.
Thank you, Chris. And we're going to take some questions, but a couple of comments first. This is a very flawed tax. And and it will have a chilling effect on business. You can have the best tax in the world, and that, by the way, is an oxymoron. But at any rate, one of the problems is until a business determines how it is going to be impacted by the tax, everything kind of freezes. And it can be for 6 months, it can be for a year, it can be longer. Because this is on gross, and we still have a lot of struggling businesses, that is definitely going to have a chilling effect. Now, a couple of points on what Chris said. We have a pretty good administrative code relative to regulations. If the tax passes, it's effective January 1st. So you're going to have to start accounting for it. However, you have, in many cases, no definition for it. So guess what? Chris starts the regulatory process, probably 50 to 60 different regulations. I don't think that's out of line, it could be more. What happens because you start the process during a legislative session, those are considered temporary regs. So we're going to get a temporary reg to tell us how we do certain aspects of accounting, but come August 1st, all the temporary regs, in addition to regs he'll still be working on, have to be re-workshopped. We conceivably can go to the end of the year, because the average business with federal returns is on a calendar year, and we'll wind up not exactly knowing what we were supposed to do. We've heard about the affiliated businesses, the groups, the apportionment. Let me give you one on apportionment that wasn't mentioned. Transportation businesses. This is a single factor apportionment formula in this bill, not the usual 3-factor. How do you apportion for transportation interstate? Texas has a regulation. Is Chris going to be able to do the regulation? We sure hope so. And we hope we'll be able to get to where Texas is. But here's where we can't get to. Texas also had a provision. Now everybody's aware that we're going to have some serious implications from Obamacare on the business community come next January. Okay? What you have in Texas is that payments made by a governmental entity for Medicaid, Medicare, children's programs, etc., whether it's federal or state, that are made to a health care provider are not included in the revenue base. That is not true in Nevada. In Nevada, that revenue that you receive as a payment from Medicaid is going to be included in your revenue base. And as Joe said, just exacerbating the pyramiding effect on a very expensive commodity to begin with. Now, I know that the Chamber always tries to keep very much on time. I think we have time for a couple of questions. So if you have any, would you raise your hand? And I'm sure a panel. And I thank you all for your attendance. Discussing taxes is not usually a great idea at lunch or breakfast or dinner, and I forgot to bring the Tums. So my apologies for that. Randy?
Thanks, Carol. Mr. Henselman, during your presentation, you made the point that the pyramiding effect was what led to the differences among the grossly outsized tax rates for different industries. That's a correlation I hadn't heard before. Mr. Anderson, in his presentation and other documents I've seen from him and others, seem to say that the difference in the tax rates are more attributable to just the peculiarities of individual businesses. Could you talk a little bit more about that? Because it would seem to me that the latter is more true, and then the pyramiding would just be added on top of that, especially as we go on year after year after year.
Yeah, it's a very good question. It's important to note that Texas's problems with the margin tax are not because of insufficient administration or taxpayers cheating it or whatever reason you want to come up with, they're inherent to the structure of the tax. The tax causes pyramiding because of the way it's designed. And it is true that different businesses have different effective tax rates. So a profitable business obviously has a very different tax rate than an unprofitable business. And if you pay people different amounts, you'll have different tax rates. But just taking the example of otherwise identical businesses that do the same thing, that sell the same thing, that earn the same revenue, but one uses employees versus independent contractors, or one uses courier services, or one sub-manufactures through subcontractors. Just that one difference results in significant differences to the tax rate. A lot of that is inherent to the structure of the tax of driving these very different tax rates. And of course, you guys are all smart. You're not going to just sit there and live with that. You're going to start modifying your businesses to minimize tax liability associated with this. And we see that especially in Washington State, which has a very problematic tax with this. There's a big incentive to vertically integrate your businesses to eliminate transactions outside the company. And I think that's helped make Washington businesses less competitive with their competitors in other states.
Kelly, I thought I saw a question over at this end of the room.
Carol?
Oh, I'm sorry, got one here.
Is this on? Yeah, I just wanted to have Mr. Anderson focus a little bit on the control group thing, because I think there's one other implication that I think everybody ought to know about. And I guess, Kurt, if you would just take a few seconds. When you are a control group, which frankly the way I read it is a lot of people in this room are control groups, you just don't know it. And you're going to be tagged. But once you choose the allocation method in the tax, I think you have to choose it for all businesses. Could you just clarify that so they understand they don't have business by business choice?
Yeah, one of the, and actually there's a problem with this in the Texas law too. You could have controlled companies that are in different industries, and you could have a situation where one company would be best with the statutory 30% deduction. Another one might be better with the compensation deduction. Another one might be better with the cost of goods sold deduction in calculating their individual margin tax. When you have an affiliated group, you're required to file a combined return. And when you file that combined return, that group becomes the filing entity. That entity is the entity that makes the decision as to which one of the three methods you're going to use. So now you have all these companies that would be better served by one of the three having to choose which one of the three to use across the board, which then wildly increases the tax. Now we have this situation in Texas with a client of ours who's in real estate and then in a technology business in Texas. Since I'm kind of a contrary kind of guy, I said, you know, this makes no sense. So we're going to file two returns. We're going to file one for real estate. We're going to file one for this technology business. And we're going to make the election separately on each one of these group filings. And we'll see what happens. Seemed like a good idea at the time. So Texas actually came in and audited us. We had a nice little lady from Texas came in about a year and a half ago, went through it all and said, yep, hunky-dory, looks good to me. So we did that, and we got it through. But the Texas law doesn't necessarily allow you to do that. We just got it through, I guess. So it's a bad thing. You can see it. It can be wild, wild.
And we have time for one more question.
Given that I've been in this town for almost 50 years and I've seen so many changes and I've seen how the unions are very cohesive in this town, in your literature at the table it said that the teachers union is the one that brought this bill forward to increase their revenue. Given the union atmosphere, how are we going to defeat it?
Well, I think, oh, if I can get this working. It is working. I think what you want to pay attention to on the brochures you received is there is a coalition, a statewide coalition that has been formed called Stop the Margin Tax. And we encourage and ask every one of you, if you, I'm sorry, Kelly. There is a brochure on the table, which is what I indicated. But if you go and go to the website. We ask for your contributions so that we can mount a sufficient media campaign. We ask for you to allow your name to be used so that we can let everyone know this is not just a couple of business groups or trade associations like our association, the Las Vegas Chamber or the Reno Chamber. We need you to be involved. We need you to go to your family, your friends, your employees, and let them know exactly how damaging this will be. When you go on the website, in addition to the forms for contributions, etc., you will find a button for a toolkit, a tab that says Toolkit. Please go on to that Toolkit tab so that you can download whatever is appropriate, from suggested letters to the editor, to posters, to information to provide your employees. With that, I'm going to get a hook in a minute, so I'm going to say again, thank you very much. Remember, vote no on question 3.
I don't know anybody in the state that has the guts to put a hook on you, Carol. Before we, I appreciate your attentiveness here, but before we go any farther, before we wrap up, I just want to invite Brian McAnally, Vice President of Government Affairs for the Metro Chamber, to the stage for just a brief.
Thanks, Bruce. I just want to follow up on what Carol was saying and let you know that we have clipboards in the back lobby area for you to sign up and join the coalition. And some of our campaign staff are waving them right now. Some of them may be at your tables as well. We would ask you to join us. There's over 2,000 people who have signed up for the Coalition to Defeat the Margin Tax, and our website is stopthemargintax.com. And we also have opportunities and staff members in the back that would help you with a contribution or a check today. If you want to leave your business card with the campaign staff or the chamber staff, we're happy to follow up and do some individual meetings with you and talk about how you can help us join this coalition to stop this. We've all heard how bad it is. But I do want to take time to thank each and every one of you that have already contributed by lending your name to the coalition and or your significant contributions from either your associations or your individual businesses. That is helping us get this message out. You'll also see the blue brochures out there, and as Carol mentioned, this toolkit. This toolkit is available for you to use for your businesses. This will help you communicate to your employees and help drive the message home. And the campaign is also working on additional toolkits throughout the summer that you can use to communicate throughout this campaign into October when we face our early voting. I thank you for being here today. I thank you for those of you who have written checks, and would ask you to please stand with us, join the coalition, write a campaign contribution, and help us stop the margin tax. Thank you.
Thank you, Brian. As you can tell, Brian is very focused, and the next few months will be critical in this effort. So I want to again thank our esteemed panelists. Joe, thanks for traveling so far. It's great to see you. Thank the Four Seasons Hotel and its wonderful staff for today's luncheon, as well as the sponsors that made it possible, Chamber Insurance and Benefits, Super Pond, Desert Companion, and KNPR. And thank you all for your attentiveness today.